Happy Friday, Eric Bible with the Bible team at Neil Home Loans. And much like the excitement today to kick off the summer 2024 Olympics in Paris, go USA, there's excitement in the mortgage space as well, as interest rates have held below that infamous 7% target, despite all the volatility experienced this week. And two, we've got some very, very interesting things that are unfolding over the next couple of weeks that are really appearing to be a turning point for mortgage rates. Now, yes, you've heard me say this, you've heard multiple individuals say this, hey, lower rates are coming. But it's becoming more and more apparent just with the data, what we're seeing within the investor circle, what the Fed is saying, what's happening on multiple levels, that this time is different. And where, yes, there is still an abundance of confusion within the data being received at the government level, the underlying tone and what is transpiring kind of behind the scenes from, again, the investor community, bonds, you name it, it does really appear that interest rates are now in a declining environment as opposed to an increasing environment. Now, we're not out of the woods yet. We still have a lot of room and headway to make, but it does appear that there is relief finally on the horizon. And we get some very important guidance next week from the Federal Reserve, which ultimately I want to jump in here today. So, first and foremost, a confused economy. As I've been advocating over the last few months, the economy is slowing, which in turn will induce a response from the Federal Reserve. That response will come in the form of rate cuts in an effort to help stimulate the economy. Now, it gets a little rocky given the fact that we've seen just some very conflicting data, and that confliction was this week through the preliminary, wow, can't talk this morning, preliminary data around, or the preliminary reading of GDP, gross domestic product, for quarter two. As we remember, quarter one was not great. We saw a very, very suppressed growth number. And the expectations were into quarter two, those numbers were going to be matched. And the preliminary estimates were to be quarter two at 2%. Well, earlier this week, it came in at 2.8, which was definitely a surprise. Now, ultimately, mortgage bonds shrugged it off. That was in conjunction with Wall Street just selling off at an enormous rate inside the artificial intelligence tech sector. But that 2%, 2.8% number was still conflicting in the sense that, hey, people are not spending, we're not outputting as much as a nation as we have in the past. How can this number be such a blowout? And when we really start diving in, and this is where investors, Wall Street, everyone really kind of picked up on is, yes, the American consumer is still spending, yes, but it's on credit. And as we've seen, and as I've advocated in the past, consumer credit is at some of the highest levels, $1.4 trillion, highest levels we've ever experienced as a nation. So at some point, that spending is going to stop. And we've seen it reflected in retail sales. The list goes on. Additionally, government hiring and government spending. Our nation, our congressional body, legislative body are spending dollars at an enormous rate, more so than when we experienced within the financial crisis of 2008, 2009. That too, at some point, is going to slow. And again, investors' bonds kind of picked up on that cue, because then in that same day, we saw durable goods, which is the export and output of actual raw product, came in well below expectations. Now, this all leads into the Federal Reserve meeting next week, Wednesday to be exact, where again, we do not expect the Fed will cut rates at this meeting. We do, though, expect that the Fed will cut in September. And most importantly, next week, we'll get guidance. Well, we anticipate to get guidance on what this next round of monetary policy will entail. And ultimately, mortgage bonds are rallying on that belief. And again, the fact that we've seen now labor, so unemployment, rise unexpectedly, we're starting to see contraction in multiple sectors. The Fed is now in a position to really focus on real-time data as opposed to lagging data to ultimately make that decision. And really some things that stood out this week: copper. Now, copper, you might be thinking, what does copper have to do with what we're talking about here? Well, copper is the quintessential element for essentially everything we consume and output as a society. We've now seen 10 consecutive days of copper declining in price, something we have not witnessed since January of 2020. And we all know the byproduct of that. Yes, COVID was a factor, but the price of copper and the production of copper is revered as a staple for the strength of economies. So the fact that we're seeing such a sharp decline, investors are really, really focused on that. And then we transition into the important information received today: PCE, personal consumption expenditures. This is revered as the Fed's favorite measure of inflation, where, yes, there was a miss. I want to be crystal clear on that. Markets were anticipating a sharper reduction on both the month over month number as well as the year over year number. They came in flat, meaning they were identical to where they were last month. However, we dive into it and we start looking at a shorter duration, specifically the 3-month trend. We're at 2.3%. And Jerome Powell and the Federal Reserve both have stated that we're looking not necessarily so much at the year over year decline, but more shorter duration. So, and the Fed has also been very vocal as, hey, we're not waiting till 2% to cut. We want confidence that we're on the path to 2%. So the fact that over the last 3 months, we've seen personal consumption expenditures on an annualized rate at 2.3, that's pretty darn close to 2%. So I share this with you in the intentions that there are greener pastures ahead. The Fed, at some point, whether it be this meeting or the following meeting, will cut rates, which in turn should have influence on mortgage rates, which in turn is going to improve affordability, which in turn is going to drive home prices up. So really the messaging we need to get to our clients now, where yes, there's a lot of uncertainty in this world. There's a lot of confusion, a lot of fear. Fear can be a catalyst for growth. Opportunities such as this allow for future wealth creation. We all know inventory is still historically low. Builders are not building at the levels needed to satisfy demand. Allowing the opportunity to get into a home now can set future selves up for massive wealth creation. If you are running into challenges in conveying this message, as I've said multiple weeks thereover, we are here to support you. We've got some amazing tools to help communicate this message that are truly moving the needle and creating action. Like the Olympics kick off today and the amazing feat that we get to see the human body do. Let's take that into our own businesses and push ourselves to achieve greater things. As always, make it a fantastic Friday and an even greater weekend. Go USA.